Welcome to the Commercial Real Estate Report. The mission of the show is to educate and empower you to build generational wealth with real estate. I'm your host, Chris Berg, head of business development with Abernathy Holdings. We go out and build Class A self-storage sites in California, Arizona, and soon to be beyond. Great guest today, former pro skateboarder, now turned professional real estate investor, also a city councilman for the city of Thousand Oaks, California. Also had a really nice exit with a brewing company. So we're going to dive into his story and much, much more. Mikey Taylor. Mikey, great to have you with us today. Appreciate it, man.
Thanks for having me. Pleasure.
So I want to get to your story, and I got to start here because I posted this on social this morning, and people are blowing it up. Recent news shows that the city, so there was a recent audit came out a few days ago. I'm sure you're well aware, developing here in California, $24 billion the state spent to solve the homeless crisis, and yet, per the audit, no one really knows where this money went. And then the city of Santa Monica comes out and drops $123 million on a 122 unit complex for the homeless. What's your reaction? What say you?
Oh, okay. So there's a lot to unpack there.
And is Thousand Oaks about to do the same? I should have to.
Yeah, there's a lot. I hope not. I feel like our city is one of the best ran cities in definitely the state, but I think you could actually stack our city against the majority of cities across the nation. I think we're run very well, and we have really good people involved, and that's, I think, the big reason why. Now, the homeless, gosh, I guess we'll start here and we'll see where this goes, because there's a lot of different ways we can take it. But one, when you're talking about money and investment, when you have investors, you are held accountable, and you have to put a lot of focus on transparency and where dollars are, going, because if you don't, you are going to get sued. You have more liability on your end. So when you kind of, I think, move over into government, you don't have the same accountability. It seems like, whether you go over budget or under budget, the only person that really pays is the taxpayer. And I'm not sure the taxpayer is really holding our elected officials accountable when they do things like this. Now, is that because the majority of people aren't really paying attention? Probably. I think the people that actually follow politics inside and out are probably somewhere around 3% of the population. So that's unfortunate. When it comes to homelessness, I think where we have to be careful is who gets involved when we see a need, right? When I was young, it was all about, the drug epidemic and how do we come in and solve the drug issue. And what you see is a lot of money and a lot of energy going towards, solving it. And I think, unfortunately, there's some people that have learned how to eat off of an opportunity. Kind of feels that way with homelessness, unfortunately. It seems like, the government's about to put money in. Okay, how can we get some of it? And it's like what feels like everything in government. It's not done fast. It's not done cheap. It's not done like the private sector. So I think that's just a new iteration of it. What I would love to see is public-private partnerships. I think that is the best way to solve this, because us as real estate investors, we know how to do this. But I guess you can take it a step further and go, this was Caruso's main selling point to his campaign. I know how to build real estate, and we do not need to build apartments for $800,000-$900,000 a unit. I can do this much cheaper. He didn't get elected, though. So I don't know. Is that on us?
100%. Number one, I appreciate being so candid. Like, I just got here a year and a half ago from North Dakota. And so I feel like this Westlake, Thousand Oaks area is just, it's like a slice of heaven in California. And I just want to bring this up, one, because of your position, two, and we're going to talk about this. When I told people I was going back, I was in California for a long time, went to college and stuff. When I told people I was going back to California, they're like, dude, are you nuts? Like, it's insane out there. How are you going to develop and this and that? But our JV partner said that's exactly why we want to go to California. It's very tough to do business there. So if you get stuff done, it's great assets. So with all you said there, I think you look at what happened with Caruso, and there's this concept idea of a homeless industrial complex.
Yeah.
Because now you got, so just your comment on that.
I want to be careful with how I say this, because I'm not saying everyone involved has ill intentions. Of course, there's people that I think really want to help, but you know, our government is just getting bigger and bigger and bigger, and unfortunately, we just don't see problems being fixed at the rate that I believe they can be. And so, I think that's one component. I think there's probably some human behavior mixed into it. Like when you have a job to solve a problem, and if you solve the problem, you lose your job. It's this like wrong incentive structure on why we're here. And so I have to believe that somewhere that human behavior is at play. Do I really want my job to go away? Uh, so I don't know. It's a tough one.
Well, especially when you're talking about 24 billion. I mean, it'd be different if it was, hey, here's maybe, I hate to say this, maybe 100 million, which is still a lot of money, but 24 billion with a B, that's a lot of money sloshing around the system. And anyway, so you sort of alluded to this public-private partnership. Last question on this, we'll move on to your story. So if you were king for a day, how would you solve this housing crisis in California?
Okay. One, maybe I'm glad I don't have to solve it statewide because truthfully, it's complex and we probably can't even get into all the nuance of the topic on this one call. But my outlook, to keep it very simple, is you have to go after the root cause, right? And the challenge that we have, and if you pay attention, you're going to notice this from now on, is anytime they talk about homelessness, they start with the price of real estate. Real estate is so expensive, and that's their segue into homelessness. And so if you're not caught up on the topic, you naturally assume, oh, if we just build housing, you no longer have homelessness. What they forget to go over is, why are people on the streets to begin with? What is the root cause? And in my outlook, there's three root causes. There's one, a percentage, which happens to be the smallest, which is people going through financial hard times. There is that component. I think it's the easiest to address. It's also the minority. Then you get into the difficult part, which is mental illness and addiction, and then the crossover that happens in between the two and how you separate those out. And all three take a different strategy to solve, right? The problem that we're facing right now is it seems like all the energy and dollars is to build housing. If we build housing, the issue goes away. So you look at San Francisco, who put a ton of money into building homeless housing, and yet the vacancy rate is through the roof. Why? Because you have to create either one, these transitional shelters that are helping people that probably are more on the addiction side get through that challenge, get back to building out a skill set and a purposeful life, and helping them transition back into the workforce. You need that structure for those struggling with addiction. For mental illness, it's a totally different type of scenario, right? Mental illness, the biggest challenge to mental illness is if you have a illness, you as an individual don't know it's there. You have an inability to see the illness. And then the next stack on top of it is mental illness doesn't start showing until usually the brain stops developing, which is going to be anywhere from 18 to 27. So now you have an adult, family and friends cannot force help, and they don't see the illness there. What do you do with that? And so I think we have to go back to mental institutions. I think there has to be an element of some type of forced help or nothing ever changes. And they're not having that conversation. They're having a conversation around housing only.
It's like they're focused on the wrong metric. And an analogy I would think of is like education. Everyone says, hey, we need more money in education. But yet, if you actually look at the output in many education systems, money's not the solution. It's just, so anyways, let's move on to your story unless there's anything else you want to add there. But I really appreciate you being so candid, especially being in a leadership position within Thousand Oaks. So
Right.
you got this great story. You're a former skateboarder. I think you were doing some investing there along the way, had some great mentorship. I had a really nice exit with a brewing company. And then because the mission of the show is to empower people to build generational wealth with real estate, you choose real estate. Why?
Okay, so when I was skating, I had a career that I loved. It was just short-lived. There was no longevity in it. So I was on this path of spending as little as I could to get as many dollars invested as possible so that when my career ended, I either didn't have to work or I had some type of cushion or passive income coming in to make that transition as easy as possible. In the beginning, it was very conventional and basic. It was retirement accounts, it was stocks and bonds, until I got to the point where I had enough to start investing in private offerings. I started investing in storage, started investing on the lending side of commercial real estate. So I had my equity or my growth investment, and then I had my debt or passive income investment. And then when I started the brewery, myself and my partners didn't have enough money to start it ourselves. So we had to go out and raise money from investors. And I kind of fell in love with that process. Like, I liked having to go out and tell investors about our idea, get them to, believe in it, then have the accountability of bringing that dream to reality, and then going full circle, selling our company and paying out our investors, which, for context, were family and friends. It was like my parents and my in-laws, my, aunts and uncles. I was giving people I loved money for believing in us. I loved that experience. And so when I went after basically the next idea of what I was going to create, I wanted to start a business. I really enjoy the process of, I have an idea, how do I bring it to reality? And then how do I grow it? But I also liked the investor side. I liked bringing capital in. And so I thought, what a good way to pair the two together, build a private equity real estate firm and raise money and put that into assets. But ultimately, I'm building my business as well in that. And so I think it's the best of both worlds.
You guys have got a really nice, at least what appears to be a really nice self-storage portfolio. So let's back up to your first investment as an LP, a limited partner. What was it about self and storage that intrigued you? And why did you end up saying, okay, yeah, I'll invest in this as an LP?
Back then, I was naive, didn't know much, and trusted somebody. That was really it, right? They brought me the offering. I didn't even know what questions to ask. Thankfully, the person that brought it to me basically answered the questions that I didn't even ask. So these are all the things that can go right. These are all the things that could go wrong. And I remember just like taking a shot on him. You've been phenomenal for me over the last decade. I'm going to trust you with this. I made an investment.
Wow.
And then once the dividends started coming in, each dividend, it was like, oh my gosh, this just shows up over and over and over. And then I went through a cash out refi and I was like, ooh, there's a hit of cash. And then basically, going through 2008, 2009, that's what really solidified it for me. When I got to experience how certain assets go through economic hard times and how others are challenged by it, that just built out my confidence in specifically storage and multifamily going through those. And, now I can speak on it more clearly. It's like, one, I'm at a point where I want growth, which I want appreciation. I do want income. I want depreciation. I want tax help. And I don't want to panic when we go through hard times. Like, going through what I did in the financial crisis, that was one of the greatest buying moments I have ever had. And so I'm really mindful that the investments I'm investing in don't become challenged during the best buying opportunities, so that I don't have to spend all my time trying to protect my assets. I can actually take an offensive position and start buying when others can't. And I feel very confident in multifamily and storage to perform well during the hard times. Considering you do it right, you can still invest in those assets and blow it and be scrambling like a lot of these syndicators are in the Midwest and South. So it's not you invest in this asset and you just naturally kill it. You still have to know what you're doing.
I want to talk about what that looks like for you guys, doing self-storage right, especially here in California, because there's a lot of people that sort of laugh and chuckle, but it's a great state, I believe, to find assets in. But before we do, I watched one of your recent podcasts where you're sitting down. I presume it's your business partner, but you guys were talking about raising money and the difficulties of that. And you're really starting to expand and grow into more of a social media investing funnel, if you will. And the reason I want to bring this up is what's fascinating to me is that here's a guy, you seem very adept at investing, even when you were a skater, but you just mentioned, hey man, I knew this dude for 10 years. So it wasn't like I just met him and hey, I trust. So speak to that 10-year relationship and how he sat down with you, went through the good and the bad, and what the challenges are now for you raising money. Because if you're doing it through social media, that's clearly not a 10-year relationship.
Yeah. So the person that I'm speaking about with that trust build was managing all of my money. Wasn't just storage.
Wow.
So I had him basically helping, he created my business, Mikey Taylor Inc., as I was going through the, skate career, and helped me, structure an S Corp to, participate in some, tax help. And, we were investing in the markets. And there was something about storage though that I liked, because I've always viewed real estate as something real. Like, even though when you're investing in the stock market, you're investing in equity in companies, like you do own something physical, but there's something that's removed about it that just feels like a bucket of moving cash that you can't ever touch. Something about real estate just felt more real for me. I don't know if that's from my parents. It was just there. But because real estate was different and I didn't really know the questions to ask, that's where the trust kind of came in with him. Now, now I don't need 10 years to trust somebody. I know all the questions to ask. And if the offering or the investment gets through some of those preliminary hurdles or benchmarks, then I'm just investing in the person. I want to know that the person I'm investing in, is a good moral and has good character and can drive this thing forward. It doesn't take 10 years anymore. I could figure this out in probably a couple months. Raising money. Go ahead if you want to ask a
I was
question.
just going to say, so I think you were just going to go there. I was kind of trying to reverse the funnel because I want, as you're going out there now and talking to people, I think it gives you a new appreciation for where they're at, realizing, hey, I knew this dude for 10 years and I still was a little bit maybe skeptical. And so go ahead. What were you going to say?
So now, this is why I got to the point of wanting to raise money online, because when we sold our business, we gave our investors a huge return, like astronomical. And so now I had a built-in base that looked at me and went, "What are you doing? Here's my money." So, when we launched it, we were kind of turning on deals. We just had the capital there. And then, I got to a point where we started doing more deals than our investors could fund. And I had to start, working at building my relationships or building my network. And I remember like 2019 going to dinners and coffees and networking events going, what am I doing? Like, this seems so old school. Like, I try to always be on kind of the precipice of like what's to come. And I felt like I was doing business the way it was done in the 80s. Like, there was something just I didn't like about it. And so I wanted to basically figure out this new way of raising money, which I looked at social media as the key. As far as like scaling, it's it. But your challenge is what you just highlighted, it's trust, right? When you don't know somebody and you can't have a physical interaction with them, the steps it takes to create that digitally takes longer. And so we had to figure it out. Now, it helps that I have a lot of people following me and have been following me for a long time. So there is a trust build there, but it's harder when you have cold leads coming in that don't know you, and the process it goes through to get trust built to then to act. It's a lot of steps, and it's a big team to do that.
You go through the Forbes 400, and a lot of people in that Forbes 400 list are in private equity. You mentioned, hey, Chris, this is great. I'm now in private equity with real estate. Like, what's been the biggest surprise maybe? And if you're like, wow, if I would have known that now, what I know today, I may not have even started this.
Oh gosh, there's a lot of those.
Really?
A
Oh,
lot.
no.
There's a lot of them. But look, if you were to ask me to go back with the brewery, I would have said the same thing. Like, there's an element to everything I start that there's some naiveness and this like, mindset that I have, which is if I do it and I do not stop, I will succeed, has got me through those challenges, right? The one that I think is probably the most frustrating is how heavily our industry is regulated. It felt like I went from being an entrepreneur to a cog in corporate America.
Wow.
That was frustrating for me. It is what it is, though. I would say the second thing, I thought that raising money for real estate would be a lot easier than raising money for the brewery, considering it was three guys who had no experience in business, no experience in the beer industry, and the risk profile was through the roof. meaning there were much higher odds that we were going to lose your money than make money. I thought that would have been harder to raise money. But going into real estate, I was kind of shocked that it was the opposite. It was harder to raise money for real estate than it was the startup. And what I attribute that to, with the brewery, we were able to throw out these huge numbers of how big it could be and how large we could sell it for. And the return that an investor could make was all over the place. On real estate, you're kind of confined into a box based on, in some regard, what the assumptions are going to be on a 5 or 10-year window as it pertains to cap rates and your interest rates and your rent growth, et cetera. So the return is kind of more, the return is in a smaller box, I guess you could say. That was harder. It was actually harder to sell a dream this time around than it was last. But I feel like I've gotten through that now. We're at a point where we're raising pretty large dollars, but different.
And to be fair to you, I mean, back when I'm presuming you were raising for the brewing company, T-bonds weren't at 5%, right? I mean, you got short-term T-bonds kicking out 5% cash on cash. And you hear a lot of people lately be like, hey, man, just, buy T-bills and chill kind of thing. So I think it's a different competition level for the cash, right?
Correct. Yeah, correct. And look, when we started the brewery, it was 3 years after the financial crisis, which people were still feeling back then. Everybody was still terrified of the next recession. And so, that was part of our pitch. Look, we're investing in beer. Everybody drinks beer during good times or bad. So, that helped. But yeah, it was still, it was a different time and a different vision.
You mentioned you're very often a forward thinker. So I'd love to hear your take on this. As I'm looking at sites and going through our buy box and, trying to find out, hey, what creates ultimately the biggest upside with the lowest amount of risk, I keep trying to figure out, hey, how can I utilize AI to help me build out some of these pro forma, some of this information? Are you currently using AI as you're looking at sites or in any aspect of your self-storage business? And if so, how?
We're not using AI yet on the modeling. We're using a lot of AI on the communication, the marketing, more on the lead source, and then investor relations is probably the majority of our AI. Not anything yet on underwriting though. To go specific on what we're doing with AI. So, one of the easy ones, we use a AI system called Exceed. And so when a lead comes in, they're sending you emails and text messages that's, a full language. It's not a, scheduled, automated, text that we've created. The thing is speaking to you inside of the framework that our compliance is set. So that's kind of one area. I use a thing called ManyChats on my social media. So if somebody, I could basically create a targeted word like invest and tell people to either comment or DM the word invest. And then that triggers the software. The software then gets their information, sends it to our CRM, and then our team reaches out, which also basically triggers our, in-doc campaign of a sequence of the emails and texts. So that's a pretty big one. We use it on, even all our social media stuff, any like YouTube descriptions, that's AI, our investor relations, newsletters, AI, that more on the communication side now than anything.
As far as self-storage, so when you go out there and start looking for sites and you're underwriting, are you focused on IRR, yield on cost? What's your buy box?
Okay, on the storage side, you could look at yield on cost or IRR. Probably both are factors we're looking at. One, though, we have a minimum threshold of a return that we're trying to hit to our investors. So if we're looking at a project level IRR, we usually need that to land somewhere in the 20%, 21%, so that when it goes through, the waterfall and how we get paid, the investor is left with a, targeted return of 15% or 15% net IRR. Yield on cost, of course, we want to see the yield on cost above, the in-place cap, so it makes sense to build, but sometimes that won't get to our return threshold just on, that metric alone. I think that's probably a better indicator on if we should be developing or if we should be buying existing. But yeah, 2-point spread. Yeah, that's what I want. The part about our storage that's a little bit unique is it's basically adaptive reuse. So we look for vacant or distressed big box retail like a Walmart or a Kmart, and we want to repurpose that into storage. So when we find markets that kind of fit our buy box, the hardest part for us, and probably what kills more deals than anything, is the city. Getting a city to allow us to do it is very challenging.
So let's talk about that. As a city councilman, why do you think there's such a negative rap on storage?
Okay, so a few things. I would say, one, in a lot of these cities today, the main issue or the issue of our time is the housing crisis, right? There is not enough homes in a lot of these areas. So, if you go to, like, let's say a city council member, the city council member is kind of gauging how many emails that he or she is getting from the residents and what the overlapping topic is. Right now, we need more real estate. We need more real estate. We need more real estate. So when they're creating policy, they're focusing on what? Homes, residential. And so when they're going through a general plan, what you're seeing a lot of cities do, let's talk specifically to California, they're putting a lot of energy on increasing density or adding more residential units. And a lot of them are actually outzoning storage. They're basically saying no more storage. All the focus is going on multifamily. Now, why is that? One, it's a political win, right? The more housing that we put online, the more housing becomes affordable, the happier the residents are. Two, storage doesn't create a lot of sales tax. It doesn't create a lot of jobs, right? So you usually see cities put it on the outskirts. Where our model becomes very difficult is because we're going after a Bed Bath & Beyond. Bed Bath & Beyonds aren't on the outskirts. They're usually in the heart of the community or the city. So you're now taking a more prime location of the area, which used to have a lot of jobs and had a lot of revenue coming into the city. And now we're saying, you only need about one employee to manage this. And, the tax, the sales tax is different. So they don't love doing it. But what we look for is cities that are basically have an asset that's doing nothing and has been doing nothing for a couple of years. And then we show them what these things look like once we go through the process of building them out, and they look good. And so we've gotten to a point where we are pretty good at getting cities to move forward, but the majority of them say no still.
Are you doing any combo? Because I know you're doing multifamily. I want to talk about what you're building or developing in Ventura. Are you doing any combos with cities saying, hey, we'll come in, we'll build this multifamily and storage at the same time? Or
no, two completely different strategies. So our multifamily portfolio is entirely focused on California. Our storage portfolio is not. This is one more for you. Doing storage in California is very difficult to do what we do, which is the adaptive reuse. We have one storage unit out here that was a ground up development. The majority of distressed assets that we find that end up working are usually outside of California. And then to add to it, because California is experiencing one of the worst housing crises in the nation, the majority of cities are converting big box retail into mixed use zoning. So they're keeping a portion of retail below and going living above. Most of them are not, they're not allowing any new storage to be built in a lot of these cities. So we don't combo that often.
Do you do anything in Fresno? Because I may have an opportunity for some multifamily in Fresno.
We don't have anything in Fresno right now.
All right, we'll chat after this and see.
Let's do that.
It's an opportunity. So Ventura, I've heard, has got, I think, the biggest housing crisis in the country. You've got a really nice development going on there. Tell us more about that. And why are you so focused on California, even though I think there's, everyone I talk to in Cali, like some real estate attorneys are like, hey, Chris, we're still doing deals, but none of the money's flowing into the state. Why are you doing the opposite?
Okay, I'm going to start with that first. So I don't know if this came from skateboarding and it was ingrained in me since I was doing that at a young age, or if this is just a personality trait. But when I was skating, because you were trying to constantly separate yourself from everyone else, you were trying to find new ways to do things that others weren't doing. And I think because I had a 14-year career, I was always a contrarian thinker, so that kids would look at me as different than the masses. When we started the brewery, it was the same exact approach. So at that time, if anybody was into beer in 2011, 12, everything was focused on these like really heavy, high alcohol percentage beers, like double IPAs. You drink one and you were smoked. It felt like you just had dinner and you wanted to go to bed, right? And on top of that, because everything was focused on the craft itself, no one was marketing. They didn't want it to feel gimmicky. So when we went in, we went, wait a minute. Everyone's doing that. What about the people that don't want to just drink one IPA and go to bed? What about ones that want a little bit easier of something to drink, a more sessionable beer? And people looked at us like we were nuts, right? You can't do that. No one does that. You're going to get laughed out of the industry. And then on top of that, we were going to create a marketing campaign that put more focus on our community and brand and less on the product or the liquid. I would say 80 to 85% of investors told us we were nuts and we were going to fail. And then once we opened, probably 2 years of the industry told us that we were whack, we shouldn't be here, this was all a gimmick. It wasn't until about year 2 when they started looking at us and went, why are they being so successful? Why is everybody paying attention to them? And then by year 4, everybody was copying us and we had completely disrupted the industry, right? Fast forward to today. What is everybody doing? Everybody's investing in the Midwest. Everybody's investing in the South. That is the last place I want to be. I don't want to be where everyone's investing. I want to be going in the area that everybody's running from. So then you look at California, right? Is it difficult to build here? Yes. Do the politics suck here? Yes. They are all at play. But when you look at what that type of policy has created, it's created a housing crisis. So the state is short by about 2 million residential units. And at the same time, investors think you're crazy for investing here. So I'll just ask you, do you think projects will be built here?
Yes. I just want to share with you, I love your process of thinking. So you and I are just getting to know each other, but our JV partner, again, gentleman from North Dakota, is at one point was the biggest private hotel developer in the country. I mean, has done, just to give you an idea, from 1982 to 2022, he averaged 1 new hotel a month. Now, I share that with you because when we started coming out to California, people would laugh at us and we'd say to him, Gary, like, are you sure? He's like, Chris, that's exactly why we want to go to California. There's such a high barrier to entry that once you get that asset, once you finally get it finalized and it's built, it is, a cash cow. It's gold. So I think you're spot on. And
that's right.
It's just brilliant how you're seeing it.
Yep. So that's what I'm doing. I'm very comfortable being in this position where people think I'm nuts because there's a small percentage of people that think just like me. And what my experience has been is when you're able to recognize the opportunity that no one else sees, you get to make a lot of money. And so we are building, I'm trying to build as much as we can. Is the capital a challenge to raise, 1 in this moment and 2 in California? Yeah, of course it is. But this is part of why I'm taking a different strategy. The majority of people that are scared are institutional investors. So when you get into our business, most groups raise money from RIAs or family offices or these big groups that are cutting, we're talking large checks. They want to get 50, $100+ million out the door, right? They are more the ones that are slow to see the opportunity. It's usually people like us that recognize it. So basically, we cut out the middleman, we go straight to the source, and we raise money online from retail investors. And basically what I tell them, this is who I am. If you feel comfortable investing where everyone else is, I am not for you. That's not what I do. I look for these type of opportunities. This is what I think the opportunity is. Here's my thesis. If we can build in areas where they're short by 30,000 units, are they going to get leased up? Yep. Is rent going to go up? Yep. Are values going to go up? Yep. So if you are comfortable doing that and going against the grain, let's go do it together. And oh yeah, by the way, this is our track record.
I was going to say,
that's my pitch.
I love how you're doing this. And so let's extend the pitch a little bit more. I want to give you a chance to give the people opportunity because I think you're still raising for this Ventura site, correct?
Yeah, we're coming up on, let's see, we close on the property officially. The close date is, I think, the 17th. So yeah, we're kind of trying to get everyone in by the 1st, just because, having somebody commit and then going through the process of getting all your documents in order, it takes a little bit of time.
So you've shared some of the thesis. Let's go through a little bit more. Like, why Ventura? Hey, if I give you 100 grand, what's my returns? What's your exit strategy? Let's go through some of that.
Okay, so why Ventura? And there's another market, at least in this fund. So for this new fund, this is basically my vision of the opportunity in California. I went and looked at what the most undersupplied cities in the state were, and then I picked the two that I think are the best. I picked North Park in San Diego and Ventura.
Wow.
So San Diego, this is where I built my brewery. Spent a lot of time down there, really like the market. The city of San Diego is short by about 100,000 residential units. So I like that component. Now move over to Ventura. Because I live in Thousand Oaks, I've been spending time in Ventura my whole life. My aunt and uncle lived on the beach. I had a whole skate community that was in Ventura. Ventura, we always looked at as this hidden gem, right? Like my wife and I used to always talk about it. How does no one know that this is here? Well, people started to figure it out. You had basically Carpinteria and Santa Barbara start to build out their tech community, which drove a lot more youth to the area. The youth can't afford living in Montecito. So they looked a little bit down south, 10 miles, and went, Ventura, this place is amazing. And then you started seeing youth come in. And then the lockdowns or COVID, especially the policy that was in Los Angeles County, that just brought a lot of people out to see what was new. And Ventura was kind of put on the map. Now, when you juxtapose that against local policy, the city of Ventura has been very anti-growth for a long time. And there's been basically a state change that has created this opportunity for people to start building, which is if a city doesn't have their housing element approved by the state, that housing element goes out of compliance. And if you're out of compliance, a developer can now tap into the builder's remedy or the developer's remedy. Basically, to keep it simple, it means that you can develop and you don't really have to fall in line to what the city regulations are or the city policy. So Santa Monica, you can't build an apartment building over 4 stories. Now you have a group coming in trying to do a 15-story apartment, and it looks like they're going to do it because the city wasn't in compliance. So it's forced a lot of cities to go, I don't want developers to come in and just build anything and ruin the charisma or character of my city. We're going to get in compliance. And so Ventura had to do that. They approved about 5,300 units over the next 10 years to be built out, and people aren't building. We are, though. I'm trying to go after about 20% is my goal of the next 5,300 units to be built. I think it's up until 2029 in their plan.
So walk us through the fund. I thought it was maybe a syndication. So it's a fund right now. And so again, I gave you $100,000, but right now you're building, I forgot, was it 66 units in Ventura? 62?
So the two in Ventura, I got to go a step back. So the other thing about what I like about both these cities, the policy in San Diego, you couldn't build an apartment past 4 stories, right? The city council went, we're not going to hit our numbers without changing this. They raised the limit to 8 stories. So that opened up an opportunity for us to buy a duplex on 6,000 square feet and develop an 8-story, 32-unit apartment. So we are maximizing square footage, right? That project we're now on the 5th story. We're projected to be finished, I believe, March of 25, right? Now we have our 2 projects in Ventura. One we closed on about 5 months ago was an abandoned car wash. And then the last project going into this fund, we have scheduled to close on the 17th. So when we bought these, they were entitled for X amount of units. One of them was entitled for around 19 units. The other one was entitled for about 46. And that was a blend of your studios, 1s, 2s, and 3 bedrooms. Well, what's happening in Ventura for the new developments that they're building, anything that's a studio 1 and 2 are leasing up like that. Anything that's a 3 is not, because that's not the need of the community. So we went back to the city and presented an idea of reorganizing the unit count. And from where we're seeing right now, we believe that we're going to increase the 19 to about 28 and the 46 to about 62. So the cool thing is we didn't run the numbers on that. We ran the numbers on the original unit count. So anything on top just makes the return look better.
So if people want to reach out to you and invest, how can they get a hold of you?
Okay, so you can either, if you follow me on Instagram or go to my Instagram channel, you can DM me the word invest and you can put your information in. Someone from my team will reach out. you can go to communecapital.com and there is a page to invest with us. You can put your information there and somebody will reach out. And you asked kind of what happens if I invest $100,000. To keep it very simple, if you look at average annual returns, about a 21% AAR. If you look at IRR, it's about a 16.5% net IRR, or a doubling of your money in 5 years. That's the simplistic overview.
Very well said. Simple, good, complex, get bad. I want to be respectful of your time. So just two more quick questions. We'll do bad news first, good news last. Worst investment you ever made and why? Like what happened?
Oh, gosh. The worst investment I ever made. The worst investment I ever made, I can't say this. I cannot say it yet because it is not.
That much pain?
No, it hasn't completely been an L yet, but it's, unless miracle gets thrown around, it's looking like an L. Well, I've had some bad ones. I was I would say the first one. This is probably the biggest learning lesson I can tell you, and I think it's relevant. When we started St. Archer, we started having success with it. Our confidence went through the roof, and we felt like we could do anything. And so, when we were building out St. Archer, we were outsourcing our marketing, or we were hiring firms to help with our marketing. And myself and my partners looked at it and went, you know what? Why don't we just become the marketing? Why don't we create a marketing company and try to create all these companies that our core business has to use and create this like web of revenue, which I actually think the outlook was correct. But what I didn't consider is time. And so, myself and my two partners invested our money into starting that and our time. And we didn't totally understand that when we dilute time and focus on something else, it's either going to challenge your core business or you're not giving enough time to the new company for it to succeed. And that's what happened. We weren't putting enough energy into the new company and we went out of business and we decided to close it down pretty fast. So that was one of my first learning lessons on the value of time. And if you don't have it, you have to outsource it.
I was going to say, and just the power of focus, right? Everyone's trying to juggle so many things these days. So that was a really good lesson. Now, the good news, best investment you ever made and why? What asset class?
Okay. The best investment I have ever made, in myself so far would have been the brewery. I paid more money in taxes when we sold that thing than I had made on a gross level all the way up to that point. So that was probably my biggest return in myself. My best passive investment was probably the first storage unit. That was a phenomenal experience. So I've done pretty well passively on storage. That was probably my best one so far.
Congratulations. And again, thanks for the time. Again, communecapital.com. Go check them out if you want to invest in some of the funds. Just reach out to Mikey. Very, very accessible, man. We just hope we can do this again. I really appreciate the insight.
You let me know when. We'll do it for sure.
All right. Thank you. Again, thanks for joining us here on the Commercial Real Estate Report, empowering you to build generational wealth with real estate.